In the last session, we have taken up the introduction to partnership. In this session, let us start with fundamentals of partnership. Fundamentals, there are so many things to learn in this, like methods of maintaining the capital account, how to calculate the interest on capital, how to calculate the interest on drawings, what to do with the guarantee of profit given by the old partners to the new partner, adjustments of profits and losses, so many things. Let us start with methods of maintaining the capital accounts. There are two methods of maintaining capital account. One is called as fluctuating capital method, another is called as fixed capital method. So before we start with what is fluctuating and fixed, first we have to learn how to prepare a capital account. Then we'll see how to apply this fluctuating and fixed. Now, we know that capital is a liability because capital means what? Amount invested by the partners in the partnership firm, in the business. Business and the partners are the two different persons, is what explained by business entity concept. So, when the partners invest capital for the partners, it becomes asset. But we are dealing with the business. We are dealing with the partnership firm, not with the accounts of partners. We are interested with the accounts of partnership firm. Partners invest the money, for partners it's asset, but for a business it becomes a liability. Because when the business is closed down, that amount has to be paid back. So, capital is always a liability. What is the rule for liability, the American accounting system? The rule for liability is this is the rule for liability. Debit decrease in liability, credit increase in liability. Now we'll see, as we know, capital is a liability. So by which transactions the capital balance will increase? We credit. The transactions which decrease your capital balance will debit. Formats are not to be by hearted. Formats are only given to make you understand how the account appears. But what should come on the debit side, what should come on the credit side, we should know the reason for that. And that is what we are doing for capital account. Let's see. Now when you talk about capital account, the question arises, what is to be taken on the debit side of capital account and what should be taken on the credit side? Now, when the partnership business is being formed, the partners will invest the money in the business. Before the money is invested, the capital balance is zero. So when money is invested, automatically your capital account balance will increase. Increase in capital is increase in liability. So whatever is the amount of capital invested, as capital will increase your capital balance, we credit that. Now, partners claim interest on capital. Now, capital, when the amount is invested, the capital balance will increase. On that capital, when you calculate interest, the question is what happens to capital? It's like when you have deposit in the bank, when you deposit the money in the bank, your bank balance will increase. On that bank balance, interest will be given by the bank. Your bank balance is, say for example, 1 lakh rupees. Bank gives you interest of 2,000, 3,000 rupees. So how much is the bank balance now? 1 lakh minus the 2,000 or plus 2,000? Plus 2,000. So interest will increase your bank balance. Similar, interest on amount invested will increase the capital balance. Increase in capital is nothing but increase in liability. So interest on capital is also to be credited in capital account. And this is what I am explaining. Remember, throughout partnership, remember, whenever you do any accounts, when you come across capital account, this is what is to be done. Now, After some time, they might feel some need that some extra capital is to be introduced. Fine. So some additional capital will be introduced in the business. When you introduce additional capital in the business, again your capital balance will increase. Increase in the capital is increase in liability. We credit. So if there is any additional capital, that also is to be credited. After a few days or after a few months, partners may withdraw the capital. That means they withdraw money for their private use, not for business use, but for private use. When you withdraw the money from your capital, what will happen to your capital balance? But obvious, the capital balance will decrease. Amount withdrawn for private purpose we call as drawings. When you withdraw the money, the drawings will decrease your capital. Decrease in capital is decrease in liability. Where we take it? Decrease in liability we debit. So if there are any drawings, we debit that in a capital account. Now, drawings, amount withdrawn from the business for private use. Business, the firm will charge interest on that. It's like when you take a loan from the bank. When we take a loan from the bank, we need to pay the interest on that. When you pay the interest to the bank, that is interest on loan. Similar here, this is nothing but a type of loan taken from the partnership firm on which the firm will charge you interest. Firm will charge you interest means whatever is your capital balance, from that they will take out that interest. Suppose you have some 1 lakh as the capital. There are some drawings of 10,000. So now your capital is 90,000. On that 10,000, some 500 rupees interest is charged. So out of that 90,000, the business will take out rupees 500. So will your capital increase by interest on drawings or decrease? Capital will decrease. Decrease in capital is nothing but decrease in liability. Decrease in liability we debit. And this transactions won't change again and again. These are fixed. Partners claim some salary, some remuneration, salary, commission, bonus. So when they receive it from the firm, but obvious what they receive from the firm, their capital balance will automatically increase. Increase in the capital. They have received salary, capital will increase. They have received some rent for any property given, their capital balance will increase. Bonus is received, capital will increase. In short, any remuneration received, capital balance will increase. Increase in capital is increase in liability. Increase in liability we credit. Instead of showing all salary and all, we'll use it as remuneration, which includes any salary, commission, bonus, allowances, etc. Now, apart from this, at the end of the year, the partnership firm may witness some profit or may sustain some loss. If there is profit, what is to be done with the profit? Distribute among the partners. So when you distribute the profit among the partners, obviously your capital balance, the capital balance of the partners will increase. See, 1 lakh is the capital. They are getting some 5,000 profit. How much is capital? Already 1 lakh. And 5,000 profit. So how much will be the capital now? 1 lakh 5,000. What they receive from the firm will increase the capital balance. Increase in the capital is increase in liability. We credit. Suppose if there is loss is to be cleared by the partners. That will not increase their capital balance. When there is loss, it's but obvious their capital balance will automatically decrease. Decrease in capital is nothing but decrease in liability. Decrease in liabilities we debit. Now, apart from this, there may be some reserves created. Whatever general reserve, any reserve fund or any other funds will be created. Partners will get a share in that reserves. That means whatever is the reserve will be again distributed among the partners. So when you distribute the reserve among the partners, partners are already getting all those things. Now you are distributing the reserves. So but obvious their capital balance will increase because that is what they are receiving it from the firm. Increase in the capital is increase in liability. Increase in liability we credit. Reserve fund. These are the basic transactions that we take in capital account. You need not by heart that. Try to understand why debit and why credit. Only based on these rules. Because as we proceed further, we have the formats. But I don't want you people to by heart the formats and get the entries done, because that is not by hearting the formats and doing, that is not accounting. In accounting, you should know every transaction, why debit, why credit. After this thing has been cleared, now we'll take up one full problem on the methods of capital account. We'll take up the problem and see in that how to prepare this capital account by using the debit and credit under fluctuating and fixed method. In this session, we have learned how to prepare a capital account. In the next session, we'll take up a problem on the methods of capital account. Thank you.